Hey everyone, welcome back to Corporate Decoder. Today, Veea Incorporated just filed a Form 8K, and I'm seeing some interesting moves in their financing. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has been busy securing funds and issuing more notes and warrants, and we are going to break down exactly what that means for shareholders. This filing is essentially an update on recent company events. Veea Inc., which trades under the ticker VEEAW, has been active in raising capital through private placements and term loans. It looks like they are continuing with their strategy to fund operations and growth. Let's dive into the White Line private placement first. This is an ongoing deal where Veea Inc. is selling convertible promissory notes and warrants to White Line Capital. Think of these notes as loans that can be turned into stock later. The warrants are basically options to buy stock at a set price. On May 18, 2026, they had their third closing for this placement. Veea Inc. issued another note with a face value of $555,556 and a warrant to buy shares. The number of shares you can buy with this new warrant is linked to how much money White Line put in and the stock price at that time, which was $0.563 per S-share. The company received $500,000 in cash after some discounts and expenses. This shows they are still tapping into this financing option. Now let's look at the secured term loans. VEEAW Systems Incorporated, a subsidiary of Veea Inc., has a loan agreement with Pasadena Private Lending. They've secured a facility for up to $10,550,000. Back in February 2026, VEEAW Systems borrowed $5,500,000. This loan is set to mature 5 years later and has an interest rate tied to the prime rate plus a margin. Monthly principal payments are due to start in March 2027. Just recently, on May 19, VEEAW Systems took out another $2,500,000 under this loan agreement. This is significant because it shows they are drawing down more funds from this secured facility. This brings the total borrowed under this loan agreement to $8 million. Companies often use these term loans for specific projects or to manage working capital. We also see some metadata here regarding common stock with a par value of $0.0001 per S-share and warrants. These are basic building blocks of the company's capital structure. And here we have details about their warrants. Each warrant allows the holder to buy 1 share of common stock at an exercise price of $11.5 per S-share. This is important because it tells us the potential future dilution if these warrants are exercised. Looking at the exhibits, the structure of these convertible promissory notes is laid out. These are the types of agreements that can turn debt into equity. Similarly, the form of common stock purchase warrant is referenced, giving us the specifics of how these options to buy stock are structured. Finally, the report is signed off by Alan Samasi, the Chief Executive Officer, on May 22, 2026. This confirms the official filing of this report. So, what does all this mean? Veea Inc. is actively managing its financing. They are bringing in funds through private placements and taking out secured loans. The private placement with White Line involves debt that can become equity, which could dilute existing shareholders if converted. The warrants also represent future dilution if exercised. The secured term loan provides capital, but it also adds to the company's debt obligations. Historically, companies that frequently issue new notes and warrants, especially at prices that might be lower than current market prices, can signal a need for cash that isn't being generated by core operations. This can sometimes lead to increased share count over time, which can put pressure on the stock price. For example, we saw companies like Radio Shack go through multiple rounds of financing and stock issuances before eventually facing bankruptcy. The key thing to watch for Veea Inc. is how effectively they use this capital. Are these funds being deployed to generate profitable growth, or are they just treading water? The exercise price of $11.5 on the warrants is notably higher than the current trading price, which suggests that those warrants are out of the money right now. However, if the stock price were to rise significantly, these could become a source of substantial dilution for existing shareholders. The risk I am watching is the potential for significant dilution from the conversion of these notes and the exercise of warrants. My biggest concern is whether the company's growth strategy can outpace the dilutionary effects of its financing activities. What I am actually looking for is a clear path to profitability that does not rely heavily on continuous capital raises. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.